Waterfall distribution works. Hey everyone, welcome to this week's video. Today we're talking about waterfall distributions, how they work, why they're in place. Now, if you're hearing what waterfall distribution for the first time, you have no idea what it means. Effectively, it's usually on larger deals for multifamily, commercial real estate, even private equity. Businesses. It's not exclusive to real estate. But what it is when you have a conglomerate of investors on a deal, it's a method of distributing funds, proceeds of the deal, profits from income, profits from the sale of a property. And why it's important, it's because it's the most common type of distribution method out there, especially as you go to larger and larger deals. A lot of you may, partner on deals and just have straight equity splits. But this one is definitely a bit more complicated. If you haven't seen a waterfall distribution before, you're going to probably question why it's in place, what's the purpose of it, why overcomplicate things. But we're going to dive into those details in a bit. So let's start with the most common waterfall distribution. I want to preface by saying there is no standard or typical distribution. It varies from asset class and type of business and the risk and the also the profile of the general partner, the person operating or the group operating the deal, and the limited partners. So depending on the dynamic with them, who has a bit more power, the split can be different. It can be a lot more complicated. It can be simple, but this is a very good starting point, go to, which is I would say as typical as it gets, especially when you're talking about multifamily syndications or funds. So 8% pref plus a 70-30 split. So what does that mean? Well, we like to break it down into steps. Now, imagine you have a big bucket, and I wish I would have, had the creative skills to be able to draw this out into a diagram, but you're just going to have to see it listed out and me explain it. But you have a preferred return, and in this case, it's an 8% preferred return. It's often just shortened to pref. And what that means is that all of the proceeds of income, when you have a sale, they go to paying out this pref. Now, the pref is all based on amount of money invested. So if you have investors, they've invested 100K, 500K, $1 million, they first get a return on that money invested. There's no money that goes to the general partner, the person operating it, unless, they could have their own cash invested in it, which is very common and a lot of the times expected. So really 8% on money invested. So if you have $1 million invested, you're expecting 80K to hit that 8% pref. Now that is annual. So this is not over the lifetime of the deal. This is 8% annual. So again, if you have $1 million invested, let's use 100K because that's probably more common, especially in smaller deal syndications. 100K, you're expecting 8K per year on your investment. So you have this big bucket of proceeds, and that hopefully it's a big bucket. It comes from income. It comes from the sale of a property. First, you have to satisfy the 8% pref return. So hopefully you've made enough that you can return 8% on all the money invested in the deal each year. If you haven't met that target, the investors aren't owed the 8%. It's just they need to hit 8% before we can jump to the next level, which is the 70-30 split. And that's where the general partner can be paid out. So if you're not following along, don't worry, we're going to get into a bit more detail, but that's kind of where the name waterfall comes from. You have this big bucket of proceeds. It goes to the first level, which is paying out the pref. Once that's satisfied, then we go to the 70-30 split, also known as a pro boat. And then after that is refi and sale, you have capital return as well. So it's really a multi-stage process, and the bigger your bucket, the more each stage can be satisfied, and you can work your way down the waterfall. That's where the name comes from. So we talked about the pref return, 8% per year paid out. Anything above that, so let's say this project is cash flowing 12%, the first 8% would go to the investors, and it's called pari passu. It's a term you may hear commonly. And what that means effectively, it's proportional to how much you were invested. So if the total deal took $1 million in equity and you invested 100,000, you'd have 10%. So you wouldn't get all of the profit until you hit 8%. It's going to be level to your investment. So proportionally, you have 10% of the overall deal. So that's pari passu. If you haven't heard of that term, it's a common language in real estate syndication and the fund world, and it relates to just proportional. If you think of just proportional, that's effectively what that is. Now, number two is the interesting part. It's a 70-30 split. So what does that mean? It means that on all money invested, whatever's left over after that 8%, 70% goes to money invested, and then 30% goes to the actual general partner. So that's the person operating, or the person or the group operating the deal. So they finally get paid on the deal themselves. And really what that is you want to say, hey, we're going to take care of the investors first. They're going to get a return on their money, that 8%. And then after that, any profits left over, we split it 70-30. And we'll get into a bit more detail about why we do that afterwards. And then third is a capital return on refi or sale. So we haven't actually returned any capital. We're just handing out distributions. Think of it like a dividend. We've been handing out dividends, which is the income. But once we actually have a refi event, especially a cash out refi, or we have a sale event, that is when the initial capital gets returned. And it gets returned pari passu, again, that term. So if you invested 100K, someone else invested 500K, their returns are going to be 5x yours until all the money has been distributed. So that's a very simple layout. Always encourage simplicity. I love seeing this layout out there. It can get orders of magnitude more complex, and we'll go into that now. So further hurdles. So what is a hurdle? Number two, we have that 70-30 split, which is called the promote. And you can actually add further hurdles to this, which means that the split gets more in favor of the general partner the higher the returns of the deal. So let's just talk about what the actual deal makes. So let's just talk about a 20% internal rate of return deal. So the deal overall makes 20%. Everyone's very happy with that return. The first 8% gets paid out as pref. So that automatically goes to the money invested, the LPs. But we still have 12% of profit left over. So in the traditional one we have above, 70 of that 12% would go to the money invested, and 30% will go to the general partner operating the deal. Now, if we threw a further hurdle in that, we could say, hey, it's 70-30 up to 15%. Anything above 15% profit, remember we made 20% profit, we're going to have a better split for the general partner. So this could be 50-50. So the first step in the waterfall will be pay out the 8 pref, and then between 8 and 15%, there's a 70-30 split. And then after 15%, we get a 50-50 split. So the general partner actually makes more money the higher return they're able to get on the deal. And this starts to fall into the reason why we have this model. If you've been wondering the whole time, why do we have a model like this? Why are we trying to complicate it? It's really incentivizing the general partner to do a good job. The more, the better job they do, the more profits they make on the deal, the better their return is going to be. And at the start, the initial 8%, they just need to clear that, and that money all goes to the money invested, the limited partners. So the better they can do on the deal, the more money they're going to make. If they only get a 7% return on the deal, they stand to really make no money on the split. So it's kind of protecting the investors by getting them paid first and then incentivizing the general partner to do really well on the deal. Now, you're going to see further hurdles in more complex structures, especially for something like real estate development, ground up development, where I've seen 3 or 4 hurdles, and that really incentivizes the GP to do a good job, to manage construction, to get delivered on time, and to sell out at the price they need to. And that is huge incentives because if they get to the really high levels of returns, the split could be extremely favorable, and it could even reverse. It could be 70-30 to the GP. So that's what we call aligning incentives. Now, to further complicate things, what we explained above is known as the the American model. There's also a European model, which is a slightly different. The European model actually pays back all money first. So when you get a pref return, when you get income, you don't pay out the pref return first. You're actually just returning capital first. So if someone invested 100K, we're going to try and return all the proceeds, are going to return all that capital first, and then we have the pref return, and then we do the split at the end. So effectively, the general partner makes no money until everyone's been paid back, their pref has been paid back, and then they can take money from the profits. So there are a couple more variations there in which the European model is actually more favorable to the GPs. But in America, we'll talk about American deals. It's American private equity. It's almost always using the American model. So just keep that in mind in case you see something that's wildly different. And then the last part we have here is advice on structuring waterfalls. So the biggest thing I would say, if you're starting out, you're just looking into potentially raising capital for a syndication, or maybe you're an LP getting involved yourself and you're reading through this. I always say that the simpler, the better. You can't assume that everyone out there understands a waterfall distribution. It's not the most intuitive thing if you see it for the first time. And I always like seeing waterfalls that are simple. 8% pref plus a 70-30 split, you can get behind that. When I start seeing very complex hurdles, multiple hurdles, mixing, elements of the American and European model, you start to question what's the reason behind this. Is there something in the deal that we're not seeing? Is it what scenarios play out that make it super favorable to the general partner or the limited partner? So always keep it as simple as possible. Is my advice. Once you start getting to the high fund levels, you can structure it whichever way you want, but you still then need to go out and get investments from limited partners, and they have to understand what that means as well. The other part of structuring waterfalls is that you want to understand why you're doing it. So maybe you are doing a smaller deal and you only have 1 or 2 investors on it. Maybe you just do a straight equity split, or maybe you just give them a straight return on their capital with a couple of points of upside. You don't need to go into this waterfall distribution. You always have to understand, why are you doing something? And the main reason I'd say the waterfall distribution exists is it aligns incentives first and foremost, and it makes it so it's fair, as fair as you can get across the board between the limited partners and the general partners. So you need to know when to use it. Don't just use it for the sake of using it, and keep it simple. So again, if you're hearing this for the first time, this is definitely a complex subject to wrap your head around. Don't fret too much, but at least now, if you come across a waterfall distribution, you can kind of see the ways that they're laid out, and they come in all shapes and sizes. Nothing is standard or typical, but definitely there are some more common variations out there, like the 8-pref 70-30 that we discussed. That's all we have time for today. Thanks for tuning in, and we'll see you next time.